out what's the mood in the market. And we've got with us Somnath Mukherjee, CIO at ASK Private Wealth, joining in on the show right now. Somnath, hi, morning. Great to have you today on ET Now. Quite curious to know how your client base is thinking about the market right now. With the FI exodus, the trade deal is still not in the works, valuation comfort a little bit, but not quite there. And then, of course, the kind of support that we've seen from DIIs in this market, making it that resilience. And, of course, the added layer of what's happening in the primary markets, that's completely different.
Right. Good morning, and thanks for having me. There is a bit of a tussle, as you mentioned, that's been going on between foreigners and strategic investors, including private equity and promoters exiting and being financed by the Indian retail investor, who remains very confident and strong in terms of his sentiment for the India story. But it looks like the tide is turning, and the first thing that we believe that the pivot of the tide turning is the fact that high frequency indicators are looking increasingly better than what we have seen in the last 12 to 14 months. While it's still a little bit scattered, it's not en masse, but significantly larger numbers of high frequency indicators across the board, especially around consumption, show that there is a turn in terms of actual on ground sentiment and consumption. That said, that is the big trigger that we think will get in more interest, including from those who have in the last 3-4 years taken the very wide pool of Indian domestic liquidity to take money out of the country, i.e. the foreigners. We've already seen, even in 2025, we've already seen the first green shoots of that. If you look at the level of strategic investor interest into Indian banking and financial services in 2025, that's been a record number. Not necessarily in terms of dollar value, but just in terms of the number of transactions, the number of deals done, and the kind of investors who've come in. And these are both strategic investors, banks themselves, institutions themselves, as well as very large private equity that have taken long-term bets. Typically, financial investors would tend to follow strategic long-term investors, because by and large, the strategic long-term investors will have a longer view of the opportunity. And if there is such a great vote of confidence from that cohort, the financial investors would tend to follow. And financials for India is what tech is to the US. It's close to 1/3 of the market. So between a turning cycle as well as the first green shoots of foreign interest in the country, the markets look reasonably well poised. We are sanguine about the markets right now.
Yeah, sure. But, Somnath, just timing it for curiosity's sake, when do you think this, pivot will actually happen? When the private market interest is actually going to flow through to the secondary market? Or do you think because of all the hot money finding its way into the new paper, that's not really going to happen anytime soon? And, of course, the number of IPOs which are lined up.
So I think one is timing is incredibly hard, and that's not something that I would venture trying to do. But I don't quite like the term hot money, because the traditional definition of hot money used to be the foreign money, the FPI money, and that has actually been on a net basis somewhat negative for the last few years, certainly for this year. So it's not so much a question of hot money, but more a question of the demand and supply dynamics in the market. From the demand side, the primary sources of demand for stocks in the market today are retail investors, especially through mutual fund SIPs, the Employees Provident Fund, National Pension Scheme. So that constitutes the largest chunk of demand for stocks. And supply of stocks comes in terms of fresh issuances from IPOs, as well as sale by private equity and promoters. The joker in the pack has been the foreign investor. And as of now, the foreign investors have been a net seller So the market's sort of been on the thin end of the wedge and been a bit up and down, but at the same level. But if we have even a small increment in terms of net inflows from foreigners, the upward pressure on prices will start. And as I said, the first green shoots of why that should happen are already visible in terms of consumption indicators. The second more structural green shoot in terms of foreign strategic investor interest in financials have also been seen in a larger, more vivid colors. So that should start now. Whether the timing is January or February is something that is enormously tough to estimate.
But with it, Somnath, hi, very good morning. This is Harsh joining the conversation. Uh, uh, with it will come the budget, and with it will come plenty of other headwinds as well, including the fact that India has stayed away from AI, and there is no significant play with regard to India stories within that AI basket. Do you believe that those headwinds could well potentially disrupt a rally, if at all that were to come through as a result of FII flows, or you believe FII flows will come in despite all of this as a possible headwind?
A couple of things. One is, I don't think the budget is so much a headwind. It's rather more talked about by people who need to talk about something rather than any material brass tacks impact most of the time. The AI point that you made is extremely pertinent. Certainly this year, one reason why India lagged most of the major markets is the fact that we lacked an AI play on the listed side. There are enormous numbers of really interesting opportunities on the private side, but the public markets in India don't have an AI play, and that's certainly been one of the contributing factors why India has underperformed this year. But that could well be the reason why foreigners look at India in the next year. We all know that there's been this niggling and sometimes even loud voice around valuation concerns and so on and so forth about AI. India being one of the few markets which does not have AI can be a fairly good hedge for an investor looking at allocating capital to markets that are not completely, driven by AI capex, which seems to be the case certainly in the US and to a certain extent China as well. India is a contra AI play, so the market does not have an AI exposure. It's a little bit colloquial, to be honest. It doesn't work so simplistically, but at least from a sentiment standpoint, that's sort of a story that could play out. Also, remember the fact that before we are done with the next year, which is year 2026, we may well have at least a couple of Indian plays on AI also coming into the listed markets as some of the data centers get listed and those kind of stories also start getting played. But no, I don't think that is a major causal reason for foreigners to avoid India anymore, because that play both on the upside in the US has had a great run, and the punishment, if I were to use that word, for India has also had that run this year. So I think it's going to play out more on the merits of the India story in 2026.
Sure. And Somnath, some of the alternatives. You've spoken about REITs and InvITs in your note. You've spoken about gold, silver. Where do you stack up in terms of a preference within the alternatives basket? Do you prefer equities over these, or do you believe that the rally here can continue? Because what we've seen is an everything rally outside of Indian markets, Indian equities. So how should one place themselves now at this juncture?
It's never an either or. It's not a question of one over the other. There obviously has to be allocation across all. But we remain extremely positive about InvITs and REITs. I think the market has developed really well. Kudos to both the regulators as well as issuers who have hit the market with issuances over the last 3 or 4 years. We see a very strong pipeline of new issuances in that area, and the market is very fast maturing into a separate category itself. So therefore, the interest as well as the appetite for that will remain very strong in 2026 as well. Gold is in the middle of a structural rally in our view. primarily on account of the geopolitics that we are seeing across the world. While there isn't any immediate replacement for the US dollar as the primary currency of global trade and commerce, there is an increasing amount of effort from everybody to find out a solution, an alternative of sorts. There's none available, but the only one that is immediate and available is gold, and hence the appetite for gold will remain strong. Last but not the least about gold is also the fact that globally interest rates have seen a secular downtrend in terms of their datum levels. What used to be high interest rates, say 10, 15 years ago, used to be double digit, not just in India, but also in the US. Today, we just came off a reasonably tight cycle of monetary policy starting 2022. And neither Indian rates nor US rates went anywhere close to double digits, or the yields, the benchmark 10-year yields, went anywhere close to double digits. So the opportunity cost of gold, which is essentially lack of carry, has come down structurally, which again goes to bolster the case of gold as an investment. So I think between both of these very structural factors, gold is in for a multi-year rally, which should continue.
Okay. Thank you so much, Somnath. We'll let you go on that note. Thanks for coming in and speaking with us. This has been an engaging conversation. Okay. Now let's bring on board